Hi, everyone. Welcome to our seasonal energy market webinar. So, thanks for joining. We're going to be looking at the market conditions as we move from the winter to the summer season. We've got another good turnout today, so thank you everyone for taking the time to be with us. We've been doing these energy updates for a few years now, every 6 months to fit in with the changing of the trading seasons. And there's always plenty to talk about, but with the current situation in the Middle East bringing market volatility and energy to the mainstream headlines, there's definitely lots to cover. So we'll get on without too much of a delay. First, though, a little disclaimer. As nice as it would be, if it was possible, there aren't any guarantees in this market update on what's going to happen in the future or specific recommendations of what you should do. As I'm sure everyone appreciates, no one knows the future for certain. The energy prices are influenced by lots of factors, some being more predictable than others, but ultimately there are unknowns and consequently price risk. Plus, not everyone has the same procurement requirements or objectives. So the aim of this session isn't to predict the future or anything like that. It's just to be informative and to help give you context to your procurement decisions. Right, so to do that, this is the agenda. Most of the attendees are going to know EIC already, so I'll keep the introduction very brief. Then we'll do a couple of quick polls, the same polls, incidentally, that we've done for the last few market outlook webinars that we've done. We would try to gauge what your expectations of the market are and what your position in the market is. Then John will go through the market fundamentals and the market prices, and then I'll do a quick overview of the key procurement options available, looking at some of the merits and considerations for the choices that you've got available to you. And then we'll finish off with some questions. We'll probably leave all answers to the end, but if you do have any questions, please ask them throughout, and then that'll help us to prepare for the end. Cool. So first things first, introduction. EIC are a business-to-business energy and carbon consultancy. We support private and public organizations with energy procurement, energy management, carbon compliance, and sustainability solutions, and have been doing that for over 50 years now. As we're looking at the market conditions today, which ties in with the energy procurement services, I've shown a few key performance highlights here. Last week, we held a webinar looking at non-energy costs. For those who attended that session, you might notice that the slide here is exactly the same, but I thought it fitted in still, and the numbers are pretty good, so I don't think repeating them is a bad thing. So for our risk-managed flexible procurement client, we've locked in savings of around £150 million over the last decade. A few important things to note on that figure. It's commodity only, so it's not inclusive of any capital at risk or trading collateral added to baseline costs. It was achieved in accordance with specific trading policies developed and agreed with each individual customer, so everyone has their own strategy. And of those strategies, the vast majority are all budget protection. So the level of market exposure and risk is explicitly agreed and managed. So it's not like loads of risk was taken to achieve those savings. It was all done in line with what was agreed. And £34 million in billing discrepancies identified and recovered last year. In an ideal world, there'd be no billing discrepancies. Everything would always be correct, but obviously that's not the case. So until it is, the invoice validation is an important part of what we do. And you can tell with the levels of savings achieved, it's definitely an important service for the clients that we have as well. Super. So if we can go on to the polls, let me see. So the first one is about what your expectations are for the market prices. So if I can ask you all to answer this question, please. So how do you think energy prices are going to change over the next year? Think they're going to go up? Think they're going to go down? Think they'll stay the same? Or you just don't know? If I just give people a little bit of time just to answer that, and I'll just remind myself what the answers were last year as well. Super. Thank you very much. I'll stop the poll there and share the results. So we had 71% thinking prices are going to go up, 14% think that they're going to come down, 4% stay the same, and 11% who say they don't know. I'd probably put myself in that 11%, just don't know what'll happen. But yeah, I think the direction of travel probably is upwards. Thank you for that. Last year, 6 months ago now, when we did the question, going up was 43%. So there was still an expectation there the prices were going to be going up. So I'll stop sharing that, and I'll just ask the next one, just to kind of understand where people's positions in the market are. When are your renewals due? Is it within 6 months, 6 to 12, 12 to 24, 24 months plus? I appreciate people might have some exposure if they've got a flexible contract, depending on what the strategy is. But I kind of figured with this question, if you've got a contract, then you're in control of your costs. So it's just to understand, the period for which you've got control and then the period for which you don't. So how are people positioned in the market? Lovely. Thank you for answering that. So we've got 24% have got renewals during the next 6 months, 28% 6 to 12, 36 12 to 24, and 12% for 24 months plus. So, I mean, with that, if share the results, if we remember that 71% think prices are going to be going up, then some people must obviously be thinking that their costs are going to be going up because they've got renewals during the next 6 months or 6 to 12 months. So there's exposure there, which the expectations people have are for prices to go up. So that's something to think about. Thank you for giving those answers. Super. So I'll finish that there, and then we'll move on to the market update. If I can hand across to yourself, John.
Thanks, Billy.
Thank you.
Yeah, welcome everybody. The next section we're going to divide into 2 parts. We're going to talk about the fundamentals in the market, or the first part, and then second, we're going to then look at prices and more of a technical look on prices, just looking at behavior of buyers and sellers in the wholesale market, and maybe give a clue as to maybe where the balance is between the two. So starting off with fundamentals, obviously everybody on this will probably understand what's going on. So the last few weeks we've been working on under 3 scenarios, some of which we've kind of shared with our customers over the last few weeks. So initially we broke down into 3 parts. It's whether the situation was going to continue as it had at the start of events. We all know that there's a choke point at the Strait of Hormuz, which prevents Qatari LNG, amongst many other products, to pass through. So I think as long as that stays the course, then there is gas that's stuck on the other side of the strait and can't get to market. That staying the case obviously would imply that the price move that we've had so far prices would kind of stay high and elevated, but with an optimism that when that opens, at least then there is some sort of retracement in price. But then we escalated that and said, well, if there is any damage to structure, it doesn't become a logistical problem. We then start to talk about gas that's going to disappear for longer, which is why what happened last week when Iran hit the LNG plant in Qatar kind of raised a lot of concerns in the market, because at first the market didn't know the extent of the damage. Prices opened higher the following day on news of that attack. When you talk about structural damage, you're talking about output that's going to be stuck for a while, can't get back to market. So therefore, customers at the other end of that chain are going to miss out on deliveries. Third one was, given the first situation, which is just a bottleneck, a logistical issue, if tensions de-escalate and the straits open, then we should start to see some retracement. So the most recent talk about ceasefire for duration has seen prices from the peak last week on the news of the Qatari damage to where we are now, at least a 24% drop in prices on some seasonal contracts. So I think everyone can agree it's a very fluid situation. It really depends on how one of these 3 or a combination continues to change and get modified as we move along in time. A ceasefire to some degree kind of allows for less damage necessarily. Certainly the risk to damage to any infrastructure for the gas in this situation gets more limited. Then obviously we need to start to see whether at some point will the straits be open to traffic, irrespective of origin and destination, because at the minute it seems to be, by reports, being very selective about what kind of traffic passes through there. So if the ships can start to move, there'll be another relief in the market. After that, we'll have to wait and see whether Qatari LNG restarts at what point. The longer the duration takes us into the summer injection season becomes more of a problem further on in time, going into the winter. Now, when we talk about Qatari LNG, again, this was never in the scope of people's understanding before. Obviously it becomes mainstream. Everybody wants to kind of understand implications. So we've got some data here about the destination for Qatari LNG. We tried to put the largest portion of it at the bottom of the chart. So we've got China, South Korea, India, Pakistan, Taiwan as the largest chunk of Qatari destination. So it's mostly Asia that's impacted on the actual delivery of this LNG while it's stuck. And as a result, it is Asian prices that have had to shoot up in order to, try to get the gas from anywhere else as fast as possible to replace what's been, what's missing. The infrastructure damage, as reported by the CEO of Qatar Energy, was that 2 out of the 14 trains at the facility were damaged. That's going to take away roughly 17% of Qatari's production. Qatari's overall contribution to the market is 20% of global LNG. With this damage, I think the market's view at this point is that it's not as extensive as was originally feared. Having the amount of capacity still on and available allows for gas to get back to market. So now it's a question of, does the strait open? If it does production start? If production comes on, there's a good chance that we get not necessarily 100% of production, but at least a really good amount of production come back online that can satisfy Asian buyers' requirements, therefore easing competition for US origin, African origin cargo that would most of the time get to Europe. Okay, so there are some European countries, if it's Italy, Belgium, that would be affected apparently by the damage that was caused. Italian deliveries, Qatari LNG is about 50% of the deliveries. The rest is from the US and others. And for Belgium was about 25% of their imports. So if this force majeure is actually enacted, then they will have to look for alternatives for source. Here we can see the reaction on prices when we're looking at global LNG price. So here we can see that prices rose quite sharply. So the three markers, the light blue is US, basically US gas price. The dark blue is TTF, but it's like a precursor for an indication of European gas pricing. And the orange is Asian pricing. And we can see how Asian prices has gone above European price. That's just the reaction of the market. If we cast our eye back to the Russian situation, we can see how both European and Asian prices rose. And for a time, European prices had to get above Asian prices in order to ensure that there was sufficient LNG to come to meet the lack of Russian gas. So in a sense, it's flipped this time around where it's Asia affected, not necessarily in the same magnitude, but still all the same, we're talking about a good proportion of gas supply that's unable to come to their market. So their prices have risen strongly compared to European. That premium allows for cargo that would come to Europe to get marketed to those Asian countries. Okay, the longer this stays on, the higher the premium Asia is going to ask in order to continue to try to attract cargo. When we look at Northwest Europe's, this is UK numbers are in here as well. We can see the mix of supply. Where does all our LNG come from? Majority of it now is from the US. So that makes the largest chunk of LNG source. Ironically, we still have Russian LNG, but the EU is looking to phase this out by 2027. So politics, energy markets, there's still a clash. You can see the Qatari contribution is sort of minimal relative to, everything that's been coming. And that's got to do with the route to travel, avoiding the Red Sea, Suez Canal, choke points. And so most of Qatari gas has been going to Asia. Now, because of that price differential, the fear here at the minute is that some of the US origin gas will divert and go to Asia, as well as African gas. So from West Africa, North Africa, it's more profitable at this point for some of that to end up going to Asia, despite the travel cost, because the premium is above that. So it's profitable for marketers to sell that LNG, flexible LNG, to Asia as opposed to coming to Europe. So the longer this goes on, we'll have to wait and see the effect on April. The longer it goes on, the higher the risk that there's a constraint still more on what comes. At the minute, for March, hasn't been necessarily that large. We've had 11 tankers that were bound for Europe diverted to Asia so far. Okay, that counts to just 10%. When we look at the volume of gas, LNG, that's come into Europe, Q4 2025, so October, November, December, was quite a healthy supply. Q1, Jan, Feb, March this year was even higher than the previous 3 years. So now the question will be, going into Q2, Q3, what will the overall deliveries be like? Will April start off slower because the constraint is continuing? Will the premium Asian buyers are asking or placing in the market be maintained, or will they find alternatives to the LNG, for example, for power generation? One thing that's kind of being skipped over is that the certain countries within Asia will be able to maneuver differently. As an example, you've got South Korea; they'll be able to restart nuclear fire generation that's currently offline. So that will help ease the demand on the gas, so they don't have to necessarily pay the higher price. If we flip that and look at UK, for example, we don't have a lot of alternatives. We don't have coal-fired generation. We're maxed out on our nuclear in a sense. So we're kind of more vulnerable on how to adapt to these things. Some other economies can adapt. China can adapt. They can fire up more coal-fired generation. They can swap to oil if need be. And other things. So adaptability to supply shocks. Some countries are better able to maneuver around this than others. And so obviously the impact by region or by country will be different. So yeah, it's a question of now, how does summer deliveries get impacted? And it's important for Europe at this point about this, because storage is important. Storage is a buffer that's there over the winter period. Europe has a large task in hand to refill in time for winter. So the light blue line shows what the 10-year average was, and we've got some dashed dotted lines here for previous years, and the dark blue kind of shows where we were, where I think we hit the target that the EU policymakers had mentioned, and storage players didn't add any more in there. And then we had the kind of fast withdrawal that did not stop. For some reason into Q1, the rate of withdrawal was just was pretty strong. We're not quite sure why. There's a few theories out there as to whether maybe Ukraine demand was added to European demand. But irrespectively, the gas that was in there was taken out a lot faster than previous years. And that means obviously there's a bigger hole to refill. I think storage players were expecting a lot of LNG. Again, we'll look at LNG growth coming up, but there's expectation there'll be a lot of supply of LNG coming that would make it easier to refill. The journey would be a smooth one. But obviously now you take off some supply from the market, and all of a sudden, the landscape has changed somewhat, and hence prices have also moved up. And the difficulty now is, given where the situation is, the optimistic view is that things come back online, but at what stage? How far into Q2? The longer this gets delayed in injection, the harder it will be to get to targets. Currently, I think these are being softened to 80% by EU policymakers, that they have to, otherwise they'll be penalized. But also the other problem for the market is that they tend to put in gas prices at summer price and look to sell over the winter. Usually, summer pricing, low demand period will see prices at a discount to winter. But at the minute, those prices are at parity, and at times the summer is above the winter. So they do not have a commercial reason to do it at this minute anyway. They need to be able to inject at a lower price to withdraw at a higher price. That differential helps them cover costs, etc., and to be a profitable profitable business, because it's most of these are commercial enterprises, not state-owned enterprises. So to be a profitable, to maintain profitability, they need a price differential that makes sense. And at this point, the market isn't offering it. I hope that point is clear. If we're looking at UK's imports, Q4 was steady compared to previous 2 years. In Q1, we've seen a bumper. We don't tend to get a lot over the summer. UK doesn't need a lot of gas supply over summer because we haven't got anywhere to put it. Without rough storage, we haven't got a large enough reservoir to put in excess. So we've only got medium range storage, which is very small capacity. But what we do have is very large LNG terminals that have large capacity. And what we tend to be, the UK's makeup is such that it tends to be more of a conduit for gas to get LNG to come in, to then make its way into European storage through exports. And then the idea is over the winter, we can call on some of that to come back this way. But we haven't got the reserves in the same way that Europe does. Even if rough, we would still be very small. Europe has extensive infrastructure, but China is slowly catching up. Now we're going to look at LNG growth, both from a supply point. If you think back to that price chart of LNG, global LNG, we had US prices quite low. Where they actually extract that gas, they don't necessarily use it internally. It can't be distributed internally. The quickest way to get to any market is then an export. So they've been slowly building out their capacity to export their LNG rather than use it internally. So the growth of exports has been, it's continuing to rise and expected to continue to be, increasing on that right-hand side of the graph ever higher. On the last webinar we got this data from the IEA, a 2025 outlook. So looking at 2026 onwards, and you can see the nameplate capacity of LNG that's coming online is on an upward trajectory. The largest contributors to this are the US and Qatari. So LNG supply is expected to only ever ramp up. So let's just keep in mind, I think, longer term as we look at price charts later on, right? So supply of LNG is only meant to be ramping up. However, if we look at this, it was hard to do this in a different way, but we've got the latest one for the 2026. The Qatari component for 2027 has gone down. Their expansion plans for the field they've taken that offline for now, obviously given the conflict and given the damage to the site. So 2027 volume's going to be less than originally thought. So we're talking about 130 BCM, whereas previously we were around 160-ish BCM. So this component here has reduced. So you could say that going into 2027, LNG supply was meant to be, 2026 into 2027, supply is meant to be increasing. You could say that increase now somewhat has reduced. Again, this could change in the coming weeks and months as we wait for more news to come from Qatar. But 28 to 30, it's still expected to continue to grow. Now, these are projects that are in the process of expansion. So it doesn't mean that these volumes will definitely appear. It's just a projection. Anything can happen between now and 2030 that would, make things shrink. Just as an example, if you had another global financial crisis, in a sense, so money becomes tight, these projects get wound down rather than come to fruition. So it's just a projection, okay? But the projection matters because it kind of gives an idea of how the big players in the market kind of have a view or sentiment on price as we go ahead in time. Now, if we look at the gas supply picture, there's obviously the headlines that we've only got 2 days worth of stored gas to meet demand. That was a very simple extrapolation to create a headline. We've done a blog for it. You can see it on our website. The supply mix is comes from various sources, but we've tried to put here what pipeline supply generally is, which is the grey, with North Sea and others, and then Langlet, which is Norwegian supply. So at least 70% of supply comes from pipeline supply, from fields, etc. And then LNG constitutes the next largest chunk. and then storage is like a top-up. So it was a bit disingenuous of the mainstream media to use a headline like that, but it's not to be, we shouldn't be surprised about that. So from a source point of view, there is flexibility. Now, obviously, as we go into the coming winters and summers, etc., Norwegian supply is very important. Indigenous supply is very important, but indigenous supply is in gradual decline. So the voices for more extraction from the North Sea will ever increase because everyone's going to start to possibly be more looking at what can we do on a more domestic front rather than relying so much on external supply, just to kind of shield or cover risk, that global risk that has an effect on our pricing. Next couple of slides, we'll just look at just a few fundamentals left. Here we're looking at heating demand. So this winter, LDZ is more the heating load. Non-LDZ, the largest chunk there is gas for power generation. We can see a step change lower. In fact, I think the heating load this winter was lower than the previous three. So overall demand in this instance was certainly lower than the previous two. The contribution from renewables relative to power generation has been quite strong this winter. Gas hasn't been utilized as much. There's been a step change over the previous two. And speaking of renewable generation, this slide, for those of you who are in the non-commodity webinar a couple of weeks back would have seen this. So this is a projection of renewable generation that's coming online in the UK. So we're here in 2026. So there's an expansion of renewables still coming to the UK. There is a projection of more LNG still to come to market on a global scale. Okay. One very important factor for the power market and by extension the gas market is French nuclear generation. It's very important for Europe that French nuclear generation is stable and strong. It accounts for a really vast majority of power generation in Europe, to the point where sometimes they actually produce excess of what they need and they export that to neighboring countries. When they have a contraction in power supply, then neighboring countries do not get benefit from that, and then they have to go look for alternatives, and those alternatives tend to be gas. So there's a knock-on effect. If they're producing at a good proportion of they're maximizing their fleet and they're producing 90% of what's required, then it kind of brings some sort of stability. If they have issues like they did when EDF talked about cracks and they had to put nuclear fire generation, some reactors offline for extended periods of time. It happened as well in 21, I think it was, or 22, at the height of the gas crisis, that added fuel to the rising gas prices, because you're then talking, this is another supply that's being curtailed, so gas has to step in, but gas supply itself was running down, and so you have a run-up in price. So anyway, projection for 26 is that it's higher still, and this is a positive for the market. Okay, takes away at least one supply shock away from the market. Right. So quickly going to go over market prices and try to look at the technical picture. Anything I'm kind of going to say here is more of a thought, not necessarily what will happen. So back in October 25, the last webinar we did, we obviously have an indication of what people thought when prices were at this point. And as Billy had mentioned previously, 42% expected higher pricing. This is a rolling front month, so it's just looking at the front month for the gas contract because it gives an idea of how prices have moved. And that's where we were. We headed lower, and then we pushed back up very strongly. Now, from here, the expectation is 71% expect higher pricing, 14% expect down. Now, I'll just quickly run through this. From a technical perspective, April, in this instance, has got to the high where we were back in January, February, where we were back in 2023. This was a run-up to the crisis, the Russian crisis, where we stayed elevated at the 300, 400, 500 mark, and then eventually broke down. But every time we've come up to this level, we've always retreated. So there's an argument from it. If we just put aside the current situation, technical perspective, at least prices could could retreat from here. It is very dependent on how the situation obviously pans out. But from a technical picture, there's always the idea that prices can come back within the range that we've been in for the last 2-3 years. If things absolutely get worse, there is obviously the chance that we push higher. That would be a structural change to the market. That would imply something, for example, like that 20% LNG that's available can never come to market for some reason. That's a structural change. Right now, the market is seeing it as a bottleneck. It can get through, it's just a matter of when. But if there's damage that 20% actually disappears from market, then that's a structural change. The market will have to price that in somehow. Asia will have to pivot the way Europe had to pivot to find where to substitute that. But the magnitude of the volume gone is not the same as the Russian supply and its inherent importantness to Europe as it was back here. Okay, we showed this chart on every webinar. This is looking at price history over the last 20 years. So seasonal gas prices, we've always capped around under the 4 pence per kilowatt mark. And then obviously the Russia gas situation showed prices shooting as high as they did, only to retreat. But they found support back at that 3-4 pence per kilowatt mark. And obviously the last 3 weeks price reaction has caused us to push further away from that support. Okay, it's the same with the power. We're roughly around 8 pence per kilowatt hour as a peak for pricing previously, before the gas structural change happened, for prices to then eventually come back. And we've been inside this range here. So we're going to zone in on this activity on the very right-hand side. Okay. So this is where we were on Friday, the 27th of February. And gas prices from there to the peak that we saw on the opening day after the attack on the field was these percentage moves, which are extremely large, and especially for the timescale. We had similar moves back here, but this took from April all the way to February. So that's many months of a gradual grind up in price based on the fundamentals at that point in time. This time we've got up to those levels, but in a space of 80% of that move was in 2 days. Okay, so it's the speed of the move that's more of a shock. But we've been here before on other contracts, summer 25 and winter 25. Okay, but it's the speed of the move that's I think more of a shock. And same with the power prices, much lower percentage terms. Price change from 27th of Feb to the peaks that we've seen, and like I mentioned, since the peak we've come down about 20%. But as you can see on the power, this still looks like we're inside a range, pretty much like how the front month contract looks. Okay, so I think any good news will likely see the price pull back inside this range. We may get away 50%. Depends on how good news the good news is. If a ceasefire continues, or ceasefire is won, and we're seeing prices react to that, we're seeing oil down. We need to see the straits open, which would be, maybe prices again react to that and push to the downside. Restart of LNG production and ships loading would be a further, obviously positive sign that causes prices to push further. Then the market maybe puts that aside for a minute and looks at that LNG supply picture, renewable supply picture, only ever increasing. And maybe that allows for prices to come, dare say it, maybe towards the bottom of the range. But this is still early days to kind of have that, a strong opinion about that at this point. I think that's where I will leave it. Maybe on some of the questions, we'll be able to attack the question of what's going to happen next. But like I said, it's very dependent on a fluid situation. The more optimistic view is that prices, if the situation improves, is that prices at least will retreat from here. How far depends on if the logistical problem is resolved, if the production problem is resolved, if then Asian buyers are getting their gas, then the competition to try to take away from Europe ebbs away, then things kind of calm down to a large degree. Now the question would be how confident will shippers be that they can use the route how confident will insurers of those shippers be that they are willing to insure those ships? And how confident will Qatar LNG or Qatar Energy, I should say, feel confident to restart production? So these are still questions to be asked, and I don't have the answers for that at this point. Okay, I guess we'll move on to the next section. I'll pass it on to Billy.
Cool. Thank you, John. Super. So the next bit's just going to explore some of the procurement options and the choices that are available to you. I'm going to skip the next one, John. Super. Or the first thing, just to acknowledge, really, or some of the, the challenges that you have to face as energy buyers when buying from the market. So, the basic ones are that there's uncertainty in the market. There's lots of factors influencing the prices, and they're unpredictable. And the reason why that's important is because the cost changes can be insignificant. And obviously, when you're running a business, that obviously hits your bottom line. So protecting budgets and managing costs is what you need to deal with. So what are your choices for managing the costs? It basically comes down to how you're going to manage the exposure to that volatile market. So, there's some ways you can manage it before you actually buying the energy you need is to reduce your energy consumption by, improving efficiency, looking at on-site generation to displace the import electricity that you need, or maybe exploring PPAs. There's also ways you can reduce the costs by maybe looking at load management, which is something we talked about a little last week with the non-commodity bits where you can use at different times. And then from a contractual point of view, it's deciding how and when you want to hedge the energy that you're going to import from the grid, which is basically done through fixed energy contracts or flexible energy contracts. And when we talk about hedging, often that gets tied in with flexible strategies, but whether it's a fixed contract or a flexible one, you're still hedging. It's just how you're hedging, which is different. So if we go to the next slide, I'll explore that a bit more. So in a fixed contract, when you sign the contract, it's an absolute hedging decision. So you're going to be effectively hedging 100% of your energy requirement for that agreed contract term. So good things about that are a high level of price certainty. You'll get a pence per kilowatt hour tariff, and you'll know, depending on how much energy you use, what your costs are going to be. So you've got that cost control and predictability. It's simpler. Everyone's a bit more familiar with it. It's simple analysis to look and say, well, that's my expected consumption. Those are the tariffs. What's going to be the cheapest supplier? And then obviously, what your production is going to be, or your energy demand, what your costs are going to be for budgeting. So it's a bit simpler because you've got that certainty. But on the flip side, it's important to make the distinction between the certainty and the risk. So although you know what you're going to pay, it doesn't mean it's necessarily a good thing. When people were signing fixed contracts, when prices went through the roof, with the situation in Russia, they knew what the rates were going to be. They didn't like it because the rates were very high. So knowing what your rates are is very different of having no risk. So having a single purchasing opportunity from a volatile market is obviously a little bit risky, and that's made worse by obviously the timing of it, because there's lots of factors influence the prices, like we said, and there's unpredictability. So choosing the time when you're going to sign the contract is difficult because it's easy to do with hindsight, looking back, but actually in the moment to know what's going to happen next, no one really knows for certain. And the other challenge you've got is just the speed of it. So when things, when prices suddenly jump up, you might think, oh, I need to reduce my exposure to the rising costs. But if everyone else is doing the same, prices are going to move very quickly, and you're going to struggle to get a contract. And also, people have sign-off processes they have to go through. So you'll want to, send your tender out to market, get the offers back in, make your choices, and generally that takes at least a week anyway. And if you want to, if you're a public organization, particularly, I know that they often have quite lengthy sign-off processes, so it can take months to actually get a contract in place, during which time you're totally exposed to the market. So I would say there's definitely more risk with the fixed approach. For a flexible procurement strategy, I would say that's anything other than a fixed one. So flexible is anything different to fixed. So if you imagine there's a spectrum, fixed is at one side, and everything else is a little bit flexible. And how flexible it is totally depends on what your chosen strategy is, which is created based on what your requirements are and your risk appetite and your tolerances and stuff. So you've got lots of choice of what a flexible contract should be. And developing the right strategy for your needs is important. So not all flexible solutions are created the same. You don't just want to take an off-the-shelf strategy and think that that's what you need. You should develop the right strategy for your own particular requirements. It does require a little bit more management, and it can be a little bit more complicated. I wouldn't say it's too complicated. I mean, I work with them a fair bit, and it doesn't take that long to get your head around them. So they're not that complicated. And I would say that they do provide better cost control and risk management. If you imagine, with a fixed contract, you're putting all your eggs in one basket, and the challenge is, you don't know what the prices are going to be when you're putting all your eggs in, but when they're in, that's it, done. With a flexible one, you've got choice when you've got your basket of how many eggs you're going to be putting in, and you can take them out, and you've got a lot more control. So with a fixed one, you might think, well, I don't want to put more eggs in a really long contract. I don't want to sign a fixed contract now for 3 year or 5 year because, I don't know what prices are going to do, and I don't know what business is going to need over that time. But when you don't have a contract, you really don't have an effective way to manage your exposure to the market. Whereas in a flexible contract, you could have the framework of a contract in place to enable, hedging to be done. But you don't have to actually buy anything all at one go. So you've got the ability to go for a longer term contract without making that same commitment on what you're hedging. So that means you can be a bit more comfortable in making that longer term contract because you've got, control within it. And I'd also say as well, you've got the benefit of speed, because when you've agreed what your strategy is going to be, if market prices move, then trading decisions can be made within minutes rather than weeks or months. It's prices are moving up and they're going to be compromising maybe the budgets that have been set, so risk has to be taken off the table to protect that. So it's much more effective at managing the risk than a fixed approach is. And if we just think back to the poll at the beginning, where 71% thought prices were going to be going up, but actually over half of the people who answered said that they had contracts due within the next 12 months. I think it was like 28 for up to 6 months and 26 after. So it was over 50% had contracts due within the next year. And I can only guess that that's because people didn't expect the situation that has happened to happen. They thought, prices looked to be softening, lots of LNG was expected. The general feeling was that things were comfortable, and maybe people were a bit more exposed to the market because they thought prices might soften and I'll get better rates. And obviously things have moved. But when they move quite quickly like that, you're then in a situation where you've got to then make a choice. You either then sign a contract and accept the fact that, the current value is what you're stuck with, or you keep your fingers crossed that prices are going to soften before you do need to sign your contract. And the amount that the prices have moved obviously impacts what your costs are going to be in your bottom line. And if you've got contracts due in the next 12 months, that probably means you've got, within budget, some uncertainty and some risk there, which, is obviously not ideal. So I would say when you're importing from the grid, you need to decide how you're going to hedge that energy. And those are your main two options. And then if you go to the next slide, please, John. So just a quick summary of what the best solution is. And it's obvious, really, that there's not a single solution that's right for everyone in all conditions. It's generally, I think, best just to be engaged, be proactive, understand what your options are and the respective merits, and make the right decision based on what your risk appetite is and what your requirements are. Make sure it's transparent, you know exactly where you stand, and probably work with a trusted energy partner, because it's a full-time job, to keep an eye on the market, to have all the systems in place to quickly manage the risk in the right way, and to check the bills and everything else. So there's definitely a value in working with someone like us. Super. So that's it for my little bit there. We'll go on to some of the questions. If anyone else has questions they'd like to ask, feel free to put them in now. The first question is, what would you say would be the grounds for an existing fixed price supplier to invoke force majeure and increase supply prices? What do you think of that, John? You're on mute, by the way, John.
Sorry, a fixed price supplier to enforce force majeure.
Yeah, I think what it's asking is, if someone's got a fixed contract, what are the chances that the supplier might come back and try and change the rates because, their costs have changed? That's my interpretation of the question.
Yeah, I don't envisage a situation like that. It's only if I think to some degree is like what's been put out there in the news and stuff. There's not a lack of gas necessarily. I don't know if this is going to answer the question. There's not a lack of gas. I think the only time is that if that gas can't get to your meter for some reason, stuff like Transco pipelines are messed up, or I'm talking like why molecules not being able to go from source to from one end to the other. In the case, for example, of this Qatari situation, is the fact that Qatar is called force majeure because they can't physically move gas from them to the customer that they'd agreed they would do so. They can't physically move that, and it's because of an outside event, not from their end. There's actual structural damage. They can't actually extract that gas to supply and fulfill the contract. So for you, for example, for now, to flip it to your supplier to be able to not supply you has to be a physical change, or the fact that that supply doesn't exist anymore.
Yeah.
But if this is in the context of we don't have gas, it's that's not the case. There is plenty of gas around, and yeah, I don't know if this answers the question.
Yeah, no, I think it does, John. I think the answer is that it's very, very unlikely that the supplier is going to change what the fixed prices are that are agreed within a contract right now. When suppliers fix the rates, they're essentially hedging in the market to deliver, to secure those prices for the customers. And then there's lots of work done, within the supplier when they shape it and stuff, but they're effectively hedging it themselves, aren't they? And although some people might take a little bit of risk suppliers might take a little bit of risk to, generate more profits for themselves, that shouldn't affect customers because they build in, a buffer to allow them to do that. Obviously within, within reason, because they obviously want to be competitive, against what other suppliers are offering, assuming you're doing, following a competitive process to secure your contracts. So I reckon the answer to that is it's very, very unlikely that anyone's going to have any rate change because of it. It's more likely that you're going to have some rate change because of non-commodity costs, like we talked about last week, for like maybe some new charges coming in, like, the different relief and support for nuclear and stuff. So very unlikely is the answer. Another question here, kind of, John, looks at, a couple of questions along the same kind of vein, putting our poll question back to us about what our expectations are for the market in the next 6 to 12 months. What do you think prices are going to do in the next 6 to 12 months? Do you think they're going to go up, or do you think they're going to go down, stay the same, or just don't know? What do you think?
I think go down is is personal, not company opinion.
Yeah. Okay.
Point. Okay. So
I wasn't expecting an answer, John, but yeah, carry on.
No, I'm thinking that at least we get a pullback of some degree.
Okay.
I think it depends on everyone's view about the situation that is outside of the market, because it's that external event, how that continues to unfold will weigh the sentiment on the market as to how prices should continue to move. So if you're going to look through the lens of optimistic view that there's going to be some resolution if the ships are allowed, irrespective of origin, to start to move. So that's the gray area. If there's compromise here and the logistical problem is resolved, there will be a relief, and you're going to see the prices retreat on that view. If the Qataris then start their production, it means Asian demand is met for that contribution. So the competition for the LNG then drops. So I think the only caveat I would put out is that we can get a retreat. I just don't know how far we get that. It's really dependent then on the shorter term continued how things are evolving. Okay, on that front. But I think we get a relief down. If things then don't improve, as in we get the relief, but then the logistical problem is still a very sticky point and the gas is still not moving, then prices don't necessarily continue down but hold. Okay, so we maybe stay inside a range that's still elevated as the market awaits for more information. So then we kind of hold that. Then at that point, it's a question of does the picture continue to become positive, in which case we get another push down, or we stay sideways, and does the picture actually get worse? Now that would be the signal. If prices were to significantly close above here, then the chances are that we're moving up higher. I don't know what brings about that scenario, but the one I painted was that 20% of global LNG disappears for a long duration. Such a thing would I think would cause that push up. We had to have a massive change in structural change in the market back here in 21 to cause prices to jump the way they did. And also we've got to, there's a lot of fear in the market, but if you look at where we are in context to where prices were at the height of the other crisis, we are still a long way lower. So I think, sorry, very long answer, but I'm of the opinion that certainly prices are inside a range when we're looking at forward contracts, and they have a likely pull down as well, as described on the front month. The push down depends on how things evolve, how deep the pullback is, and then consequentially whether the news gets better or not. If it doesn't get any better, prices hold. If it then gets better, prices continue to decline, like I've just described. If things get worse, then we continue to push higher. And then the long-term trend is that we're in a medium to long-term uptrend. Sorry.
No, spot on. Thank you, John. You started off in the down camp and then you kind of ended up in the don't know camp.
No, I think shorter term, in the next 6 months, it's down. I think as long as the news gets more positive, we go down.
Yeah. Well, hopefully it will. But that's it. Thank you very much, John, for running through all that with us. Sorry that we overran by a minute, but we started a minute late, so hopefully that's all right. Thank you everyone for joining. We'll distribute a record of it after later on in the week. Thanks very much for joining.